is The Morning Show. I'm Glenn Mobergen for Kate Archer-Kent, and this is On Your Money. Our regular guest, Kevin McKinley, has the day off today, so we're going to do something a little bit different. We're going to look at long-term care insurance, what you need as your loved ones grow older, what you don't need, and how to pay for it. Our guest today is Matt McCann. He's a leading long-term health care specialist and the president of McCann Insurance Services, Inc. in the Chicago area. And he'll be telling you that Medicare typically doesn't cover nursing homes or in-home health services, and the cost can bust the budgets of many families with aging relatives. So, what questions do you have about long-term care insurance? Are you trying to figure out if long-term care coverage is right for you or a loved one? And if you're currently paying for long-term care insurance, what has your experience been like? The show always works better when you call in, and we'd like you to do that at 1-800-642-1234. That's 1-800-642-1234. Or you can put a comment on our webpage, ideas@wpr.org, or you can tweet us at WPR Mornings. Matt McCann, thanks so much for being with us today.
Well, thank you, Glenn. Glad to be here.
Well, tell us about yourself. I can tell by just that one line that you've got a radio voice, and I've been told by my producer that you used to work in radio. So how did you wind up selling long-term care insurance for a living?
Yeah, I certainly didn't go to college to quote-unquote be an insurance agent. I spent most of my career in radio. Matter of fact, my first radio job was when I was 15. They had no clue I was 15 at the time, and once they found out, they let me keep working. What happened, and I worked all over the country. I was in San Antonio at the time. My mom, at age 59, ended up having some health issues. I ended up working in Chicago, and those health issues progressed, and she ended up in a nursing home. So I kind of saw firsthand at age 59 the impact of long-term health care had on my family, both financially, physically, emotionally. And at that point, because if anyone that knows anything about radio, ownership changes, format changes, the station I was working at the time went through a series of format changes. My job offers were all outside of Chicago at the time, and I saw an ad in the Chicago Tribune about this long-term care insurance, and I thought to myself, well, gee, I know a little bit about this. I'll do this temporarily. So I've been doing long-term care temporarily since 1998. It's kind of a joke now that I've been doing it temporarily, and I have a national footprint because of the internet and technology. So I help people across the country plan for the financial costs and burdens of aging, which is impacting Americans, as you well know.
Well, you're never too old for a career change, particularly if you work in radio. I've been doing radio since 1970, and I've worked for multiple stations. And as you said, formats change, and sometimes you quit, sometimes you get fired, and you just pick yourself up and move on. But you have moved on into a whole new realm, and it's obviously something that you believe in pretty passionately.
Absolutely. I do it on a level now where I actually see the flip side of these policies. It's one thing to sell a policy that you think is going to help. It's another thing to actually see the positive impact at the time of claim. And I go through claims, unfortunately, all the time. Usually it's an adult son or daughter that is the first person that contacts me. And the thing I get from the family is the fact that their mom or dad had a policy allowed the family to be family. And I think that's really key. We think of long-term care insurance, or perhaps any types of insurance, as something that has to do with money. And money's important. I don't want to say it's not. But when we talk about long-term health care, the impact on family is tremendous. You just imagine the emotions going through. Often it's a daughter or daughter-in-law that has to manage the situation, if not be a full or part-time caregiver. You have siblings getting involved, and always there's one son or daughter that's the most active, and maybe someone else lives somewhere across the country, and then you get you're not doing your fair share type of thing. When people have long-term care insurance and there's a plan in place, it really reduces that burden and allows family to be family. And that's the nice thing today is I do see that positive impact week in and week out when people go on claim.
Well, most insurance plans cover things like hospital stays, doctor's visits, and prescription drugs. What exactly does long-term insurance cover?
Well, I think it's important to understand what health insurance and Medicare supplements cover when it comes to long-term care first. Your health insurance that you have right now, if you're of working age, or Medicare, if you're 65 and older, and whatever Medicare supplement you may have, will generally cover 100 days of skilled long-term care. But most long-term health care is what we refer to as custodial care. And when we talk about custodial care, we're primarily talking about activities of daily living, things that we take for granted, eating, bathing, dressing, going to the bathroom, moving from one place to another, that at some point in our lifetime, either due to illness, accidents, or just the impact of aging that we need help and assistance with, or we need to be supervised due to cognitive impairments, be it Alzheimer's or dementia. It's hard to read or watch or listen to any type of media without hearing about, the quote-unquote epidemic of Alzheimer's and dementia. There really is not an epidemic of Alzheimer's and dementia. What there is an epidemic of people living longer. Longevity is a huge issue. So since health insurance and Medicare supplements really don't pay for long-term care, what long-term care insurance pays for is all those other things that they don't pay, whether it's care in your home, whether it's skilled, semi-skilled, or homemaker and companionship services, adult daycare. A lot of people even don't know that adult daycare exists. Adult daycare is really an option for people that want to try to stay in their own home and avoid a facility. So during the day when their needs are greater, they're dropped off and they come home at night when their needs are less. Assisted living. You can't drive anywhere in the country without driving by assisted living facilities. It's really become an option for people to maintain a level of independence and avoid a more formal institutional facility like a nursing home or memory care unit. And policies obviously pay for all those types of facilities as well.
Well, give us a sense of what some of this costs. Home care, assisted living, nursing homes. What can the price tag be on those?
Well, the cost of care is expensive. In Wisconsin, for example, this is based on the cost of care survey conducted by Care Scout and Genworth Financial, which is one of the leading insurance companies in the long-term care insurance industry. Home health care, based on a 44-hour a week, which is a lot of home care, is running about $4,500 a month in today's dollars. Adult daycare is relatively inexpensive. It's about $1,400 a month. Assisted living, now these are just base averages, median averages. It runs about $4,000 a month. And, of course, skilled nursing in a nursing home is always the most expensive type of long-term health care. Luckily, it's the least used, but it is the most expensive. And skilled care in a nursing home is running about $9,000 a month today.
So we're talking about $90,000 a year.
Absolutely. Now, if you're 55 years old and you're planning for your future retirement, that's the cost today. But by the time you probably need care, you're talking about, 25 years down the road, hopefully. You don't want it to happen sooner than later. Obviously, with my mom, it happened sooner, but it does happen at all ages. But in 25 years, based on past trends, that same cost of a skilled nursing home, for example, is going to run almost $19,000 a month. Home health care, which is obviously less expensive, is still going to be about $9,400 a month.
Well, that's an incredible amount of money. We're talking close to $240,000 in the future for nursing home.
Yeah.
Do I have that right?
Absolutely. I'm not a math major, but you take $19,000 times 12, and there you go.
Well, how much of that would this long-term care insurance cover?
You design as a consumer the amount of benefit that you want. And a lot of it is really dependent on the age that you're getting your policy, the amount of assets that you wish to protect, what level of co-insurance that you wish to have, and we can get into that a little bit later on, too, and where in the country you might retire to. So, for example, if you live in Madison and you get tired of winter, I can't imagine anyone in Wisconsin getting tired of winter, right? And you decide, you know what, I've had enough of winter. I can pick up the Green Bay Packer games on the satellite. I'm going to move to Florida. Cost of care in Florida is less expensive, or Georgia, or Alabama, or most of the South. Now, occasionally, I talk to people in the South who, for whatever reason, are going to move to the Northeast or the Northwest where the cost of care is more expensive. So one of the things a long-term care specialist like myself will ask is not only, where you live now, obviously, but where do you think your future plans might be? And obviously, you never know, right? This is life. Things change. But often by the time we get close to 50 and get into our 50s, we have an idea of what ideally we want to do. So we know where in the country you might live. We know where the cost of care is going to be. We know how you're going to finance your future retirement. So if you have a defined pension, the amount of insurance you probably need is going to be less than someone who's going to fund their future retirement with earnings off investments from like a 401k, IRA, 403b, or some other type of asset. In that case, we have to kind of protect the principal of your savings, which is going to produce that future retirement income. The key is if the person that you are talking to as a consumer, that insurance agent or that financial advisor, isn't asking those types of questions, they're not doing their job, because it's key in policy design. The other thing is family history. Now, family history has very little to do with your actual risk of needing care, but it does have somewhat to do with your risk of having a longer than average long-term care situation. It tends to run in family lines, not exclusively, but if you tell me, gee, you know what, my dad had Alzheimer's, two of his brothers had Alzheimer's, and my grandfather had Alzheimer's. Well, guess what? We're going to be planning a different type of long-term care insurance plan than someone that may not have those types of family history.
So, Matt, you're saying that these long-term care policies can be tailored to individual people and individual needs. We'll be talking more about that and taking your phone calls on Your Money on the morning show. I'm Glenn Moberg for Kate Archer-Kent, and in for Kevin McKinley today, our guest Matt McCann, a leading long-term health care specialist and president of McCann Insurance Services, Inc. in the Chicago area. We're talking about long-term care insurance and how do you beat the cost of nursing homes and in-home health services. It's On Your Money on the morning show. I'm Glenn Moberg in for Kate Archer-Kent, and in for Kevin McKinley today is our guest Matt McCann. He's a leading long-term health care specialist and president of McCann Insurance Services, Inc. in the Chicago area. We're talking about long-term care insurance and how do you beat the cost of nursing homes and in-home health services. We've got a lot of calls stacked up, so we are going to get right into it. Let's go to Sandy in Mineral Point. Sandy, you're on Your Money.
Thank you so much for taking my call. I looked into long-term care insurance back when I was in my late 40s, early 50s, and it was so horrifically expensive that I couldn't afford it. And so I just basically let it drop and probably won't ever get long-term care insurance.
All right, Sandy, thanks so much for the phone call. Matt McCann, she says what you're selling is too expensive.
Well, that has more to do probably with the person that sold her the program than the product itself. What happens often is that the people who sell it, which are for the most part not long-term care specialists, they're financial advisors or they're general insurance agents, since they really don't understand the product, they don't ask lots of questions, they tend to over-insure dramatically. So, for example, someone in the average age of my client is about 52, 53 years old. So a 52, 53-year-old today, okay, can get a very solid partnership certified plan. We can talk about what partnership is here in a bit. But they can get a plan, a couple, okay, let's say age 55, 52, assuming they're in good health, in the neighborhood of about $160 a month. Now, I can make that a whole lot more expensive. And there are some situations where you may want to design it much bigger. But that's why these plans are custom designed. Each individual is different. They have different types of retirement plans. They have different amounts of assets. And a long-term care specialist is going to ask a lot of questions. So it's really in the policy design. I would say quite a few of my clients have premiums well under $150, many under $100, depending, of course, on where in the country they are, their actual age and health, and the amount of benefits that they purchase.
How old would you have to be, or how young would you have to be to get a policy that only costs $100 to $150? Well,
for example, let's take a single 55-year-old. All right, a single 55-year-old in Wisconsin. If we do $4,000 a month in benefit with $150,000 pool of money growing 3% compounded. That means your benefits, both the monthly benefit and that pool of money, grow every year by 3% on a compound basis. Not your premiums, but your benefits, which would be partnership certified in the state of Wisconsin. That premium would be about in the neighborhood, depending on the company, anywhere from about $130 to $150 a month. Now, if you're married, you'll have spousal discounts on top of that. If you have bigger benefits, the premium is going to be higher. If you have smaller benefits, the premium is going to be lower. Women pay more than men. Women pay more than men for the exact same reason life insurance is less expensive for women than it is men, because women live longer and they thrive in a caregiving environment. So often with a couple, that kind of goes into the wash because of the discounts for spousal discounts that are available. But that kind of gives you the idea. It really gets into the fact is what's your age, your health, because obviously you must health qualify, and many people that age qualify for preferred health benefits or discounts, I should say.
And again, you're talking 50 to 55 years old?
Yeah, correct. Absolutely.
Let's go to Jane in Kewanee, 1-800-642-1234. Jane, you're on Your Money with Matt McCann.
Hello, Matt. Thanks for taking my call. I'm the County Veteran Service Officer in Kewanee, Wisconsin, and I was curious if you could speak to some of the VA benefits that could provide income for both wartime veterans, surviving spouses, and how nursing home care can be paid for by the VA if it's related to military service injuries or illnesses.
You are right. If you are a veteran and have service-related injuries, you can qualify for VA benefits. Obviously, if you're a vet with limited assets, you can also qualify for VA benefits. Now, often the vets I speak with may decide to not rely on the VA benefits or to supplement them because they don't want to go to a VA facility if they need to go to a facility. But that's one of the questions I certainly ask when I speak with people is, are they a vet? Do they have a service-related injury? There are programs that are available, obviously, in those types of situations, and not everyone needs long-term care insurance. Just like I ask questions about people's finances. If you don't have assets to protect, then this is not an expense that you need. Because Medicaid or VA has a similar program for those with little assets, will pay for long-term care services, depending if you meet the qualifications. It is key to make sure as an individual, if that financial advisor or that insurance agent is not asking you those types of questions, that you volunteer that information or talk to someone else, because you don't want to buy something that you don't need.
Well, Matt McCann, not everyone who wants to have a long-term care policy can get it. You've mentioned a few times now that you have to qualify for it. What are the qualifications? And Jane, thanks so much for the phone call.
Every insurance company has their own underwriting criteria. When we talk about underwriting, it's the insurance company's rules and regulations on who they will insure and who they won't. Let's talk about some things that are automatically knockouts. Obviously, if you're already in a care situation, no one's going to insure you. How would you charge for that? If you're going to immediately become a claim, you would have to charge more than the cost of care. So that doesn't work. So if you have memory loss, Parkinson's, there's huge books, what they call underwriting guides, that go through the various health conditions that either make it a little bit more difficult to insure or in many cases impossible to insure. And that's why I like to tell people that it's your relative good health today that gives you the opportunity to plan. You can't wait till the fire starts and then decide to get a policy. I mean, think of it this way. If you didn't have homeowners insurance and your kitchen started ablaze and your house is burning down and you called, State Farm, Allstate, Nationwide, whomever, and said, I'd like to insure my home right now. And you told them, does it matter if my house is burning down? What are they going to say? They're going to say, well, you know what? When you rebuild, give us a call, right? So you can't wait till your health changes. That's why I think one of the things that's happened, especially in the last 5 to 10 years, is that average age of the person looking at long-term care planning has gone down. When I first started in 1998, the average age of my client was 68. They had already been retired. This is an afterthought. And today it's about 52, 53 years old. So we've seen a dramatic swing. Part of that has to do with the fact that the Gen Xers and the late boomers have seen what happened to their parents. And the other part of it is just more people are aware of the impact of aging and longevity today than they were in 1998, for example.
You're listening to Matt McCann talking about long-term care insurance. Matt is in for Kevin McKinley today on Your Money. I'm Glenn Moberg in for Kate Archer-Kent. Let's go to Ralph in Madison. Ralph, you're on Your Money.
Yes, my question is, I guess, who decides when you can actually access these benefits? Insurance companies typically earn to make money, and they don't want to pay out benefits. Who decides what and at what level you're eligible to use the benefits?
Ralph, that's a great question, Ralph. And with most companies, it is your healthcare professional that certifies that you need assistance in at least 2 of the 6 primary activities of daily living, or you require supervision due to a cognitive impairment. Now, the insurance companies aren't going to take your word for it. They will, in many cases, get medical records. They may send a nurse to confirm information. But generally speaking, it is your healthcare professional that does the certification. I go through lots of claims. I've never really had a problem with any company at claims. Matter of fact, when there is a problem, it usually gets in the media because it's unusual, and often it has to do with a consumer wanting something covered that was not in the policy. I'll give you an example. There was a couple of stories a number of years ago in California where the consumer had a nursing home only policy. Well, they didn't want to be in a nursing home. They wanted to be in assisted living or home care or whatever the situation was, but the policy didn't cover that. And they ended up suing the insurance company, and I'm not sure what the outcome is. They probably settled in court because it's cheaper than to keep on going in court. But the point was that the policy didn't cover that service. And usually when we see problems with a claim, it has to do with either the policy didn't cover that service or that there was a problem with the medical records. Often that we see situations where there's errors in medical records, and we get it corrected. We move on. The same thing with underwriting. Sometimes someone is turned down for a policy because their medical records indicates that they have condition X when they don't. But for the most part, claims process is fairly smooth, and I never really have a major issue with a claims situation.
Ralph, thanks so much for the phone call. Let's go to Steve in Whitewater now. Steve, you're on Your Money with Matt McCann.
Hi, thank you for taking my call. One of the issues that I have is that, Medicaid and Medicare actually does, pay for some of these services if you don't have a lot of money. The other thing is that the people who do have some money, pay exorbitant fees at these memory care centers and places. The care for my wife is almost $7,000 a month here. And the other issue regarding that is that these facilities, pick and choose who they will take. And the only place that I could place her was almost 50 miles from me, which means I put on 100 miles a day just to go see her, on top of the issue of the cost. I'm saying that, you're talking about $150, $160 a month for someone in their 50s, but very few people can even afford that, to be real frank. And many people of that age are, at the beginning of, the best part of their career. And they are looking at a house, they're looking at kids, they're looking at all kinds of other expenses that, just seem really, really important. And long-term health care, is an expense they just really can't justify.
Steve, thanks so much for the phone call. We've got two concerns here, Matt. One, that even some people in their 50s can't afford it, and the other, what do you do with nursing homes and long-term care facilities that simply don't admit people, and you end up having to drive 50 miles one way in order to visit your wife?
Well, and that's the issue with Medicaid. When you're in a situation where you have to be in a Medicaid facility, that means you have to place the individual in a facility that has an open bed that will accept Medicaid. And that's why ideally you want to plan in advance. And certainly there are people that can't afford, even $100 or $70 a month. But long-term care insurance is an asset protection product. Now, most of the people I talk to, and I talk to anywhere from 8 to 15 people a week across the country, certainly there are people I run into that cannot afford that. And when you go through their assets, they don't have savings. Maybe they don't even own a home. This is not an appropriate product for that. It's not for them. Medicaid is in place for a reason. It's that safety net that the taxpayers of the states and of our country have in place to cover these types of things. However, if you do have savings to protect, and you're putting money in your 401k and your IRA and what have you, you ideally want to protect that savings as well as reduce the burden on your family. It gets back to the plans can be designed any way that you want to. There are many, often I run into a situation where people say, look, I just want a little bit of help. I want to avoid going into that facility. Maybe my family can help part-time. If I can get, some home care coming in, that would be a great relief and lifting some burden off the family.
So you can design policies that maybe cover some of the expenses, but not all of them.
Absolutely. And I think that's a key thing to remember. You design the plan based on your situation. We do know that most long-term health care is at home. It's not in that nursing home. It's at home. It's an adult daycare and then assisted living. Nursing home is the last place people go to. Fewer and fewer people end up in nursing homes anymore because there are so many better options than your traditional nursing home.
Let's go to Joan in Milwaukee. Joan, I see on my computer screen here that you've got a very practical question for Matt McCann.
Well, yes. We have a farm we put in the Mississippi Nature Conservancy years ago, and we wanted to protect it. We bought long-term health care insurance policy, and it was purchased by another company, I think Conseco. At any rate, this policy we had said if you paid into it for 5 years and then one of the spouses died, the other would not have to ever pay any more insurance. Well, that unfortunately did happen, but in the process, this company was sold to another company, and they sent me bills, and I said, no, I have a statement that you indeed that the policy started with the old company. So if I hadn't had that, I would have missed the whole thing because my husband died 17 days before 5 years with the new policy. But getting up to date, I am in a long-term care home that's marvelous, that has life care. And I still have this policy. What if I need to go into the nursing home part, what benefits will that be? How will that be taken care of?
Joan, thanks so much for the phone call. Let's get a response from Matt McCann. Matt, your response to Joan's concerns.
Well, let's go to the first part of it. And the contract that you get from an insurance company can never be changed by another insurance company if that plan was purchased. And it does happen where, just like mortgages are sold, insurance companies sell their book of business to other insurance companies who administer those policies. They cannot change the benefits. If the policy says there's a survivor benefit and the premium is waived, they have to honor it. And it is absolutely shameful that Conseco in that case, or whoever bought the Conseco plan, I'm not sure which way it went, didn't realize, and you had a fight with them. And I think that goes back to making sure that you have someone helping you, that you have a long-term care specialist or some kind of person that will help you deal with those types of problems. Those problems happen. They don't happen often. But when they do, I intervene on behalf of my clients. Matter of fact, I intervene on behalf of people that I have no connection to because they just find me on the Internet and they're looking for help and they don't know where to get the help.
Joan, thanks so much for the phone call. We are listening to Matt McCann. He's a leading long-term health care specialist and the president of McCann Insurance Services, Inc. in the Chicago area. He is in for Kevin McKinley today on our regular Tuesday feature, On Your Money. I'm Glenn Moberg in for Kate Archer-Kent. We'll be back with more of your questions after this short break. And it's On Your Money on the morning show. I'm Glenn Moberg in for Kate Archer-Kent, and in for Kevin McKinley today is our guest, Matt McCann. He's a leading long-term health care specialist and the president of McCann Insurance Services, Inc. in the Chicago area. We're talking about long-term care insurance and how to beat the cost of nursing homes and in-home health services. What questions do you have about long-term care insurance? Are you trying to figure out if that is right for you or a loved one? And if you're currently paying for it, what has your experience been? You can give us a call at 1-800-642-1234. That's 1-800-642-1234. Or put a comment on our webpage, ideas@wpr.org. Or you can tweet us at WPR Mornings. Let's go to Linda in Milwaukee. Linda, you're on Your Money with Matt McCann.
Thank you. I have long-term care insurance, and my two concerns are, one, every year when I pay the premium, I wonder if the company is still going to be around in 30 years' time when I might have a claim. And because of the rising costs of health insurance, I'm concerned also that at some stage they'll put up the premium so much that I might be able to afford it or have to stop paying after all the years of paying. So the longevity of the companies and the potential hikes in premiums going forward are my concerns.
All right, Linda, thanks so much for the phone call. Matt McCann, your response.
Yeah, those are great concerns, Linda, but luckily there's controls on it. First, premiums are intended to remain level. They're based on the age and health you are at the time of application. Now, intended to remain level does not mean guaranteed. There are situations where premiums can go up. And we have seen in what we call legacy policies. These are the old plans that were sold years and years ago. We've had increases on those. There's a lot more regulation today. We know today that people don't lapse these policies. The lapse rates are almost nil. That's not what they thought when they started selling these in the 80s and 90s. But no one gives up these policies. As far as the insurance companies go, certainly when you talk about some of the big names in the insurance industry, whether it be for instance, MetLife was a big long-term care insurer, Prudential, John Hancock. You've got Mutual of Omaha, New York Life. You've got a lot of big names, and certainly things can happen. But in long-term care insurance, by law, every insurance company has to put money in reserve. That reserve fund is separate from the rest of the insurance company's assets. So in the unlikely something were to happen to the insurance company, they go to the reserve fund. And every state has what they call a guarantee association, which basically is the insurance on the insurance. So you have a safety net. But when you buy a policy to start with, you want to start with a company that's fairly strong to begin with, so that likelihood 10, 15, 20, 25, 30 years is substantially less. And the same thing goes with the premiums. If you're buying a policy today, they fall under the new regulations. They have to prove a substantial need. Actuarially across the board to an entire class of people. They can't pick on you individually. The Society of Actuaries says the chance of increases on today's priced policies, and everything today is priced based on the extreme low interest rate environment and the low lapse rate environment, is small. It's not impossible, but it's small. But you can always reduce benefits in the future if there's ever a rate increase to avoid paying more. So there are things you could do if, 15, 20, 25 years from now something were to happen. You can always reduce benefits and thus your premium.
Linda, thanks so much for the phone call. Matt McCann, there's a bill in the Wisconsin State Legislature that would allow residents to set up long-term care funds the way they do EdVest college savings plans. People could make tax-exempt contributions, then withdraw that money tax-free. It's a proposal that has bipartisan support. Now, you've been following this story. What good do you see coming from the program, assuming that it becomes law?
Well, it's kind of based on a couple of other states who had the program, and one state, I believe it was Nebraska, has just shut it down because there was very little interest. In my mind, the way it's set up now, it doesn't make sense. to put in a sum of money that would be substantially more than any insurance would, and to grow on a tax-deferred basis to pay for long-term care. Now, there are situations, of course, where someone might have some health issues. Maybe they were born with CP or some other type of health issue, and that's where I see the big benefit of a program like this. So someone who has health issues, they have some money they can set aside, or a family can, or a spouse can, and that, I think, is ideal. The other thing that I would recommend is that people can withdraw money from these accounts to actually pay for their long-term care insurance. In other words, they've got this account that can grow tax-free, and then they can pay the premiums out, just like you can, for example, with health savings accounts. If you have an HSA, you can pay your long-term care premium using pre-tax money out of HSAs. The bottom line, I think, and one of the biggest issues when we talk about long-term care as a public policy issue, is the level of denial much of the public has about this issue. People don't like to think about it until it happens to someone close to them. So a lot of this stuff is talked about, whether it's talking about, insurance, whether it's talking about public policy, whether it's restructuring Medicaid or Medicare, and it sits there because people, it's not going to happen to me, I don't care.
Let's go to Patricia in Milwaukee. Patricia, you're on with Matt McCann on Your Money.
Good morning. I was wondering if you could speak to purchasing life insurance or some kind of hybrid to insure against long-term care needs versus use it or lose it long-term care policy.
Matt McCann?
Absolutely, Patricia. Those policies do exist. They are called hybrid plans. These are either life insurance or annuities with a rider for long-term care. Only a handful actually use the actual triggers for long-term care as defined in a regular long-term care policy. So you have to be careful that there's not wording that makes it more difficult to use the benefits for long-term care, or in some cases not be able to use them at all. The nice thing about these hybrid plans is you're going to get your money one way or the other. You're either going to get it in tax-free long-term care benefit, or you're going to get it in a death benefit. The downside is what I call the opportunity cost. These are expensive, and you're basically self-funding your long-term care to a certain extent, because when you need care, and the risk of needing care is obviously very high, they're going to give you your money back first before they start giving you the insurance company's money. There are situations where these are ideal. For example, if you have substantial cash value in an existing life insurance policy, you can do what's called a 1035 tax-free exchange and exchange it for a hybrid plan. There are other situations where they make sense. That's where a long-term care specialist can help you. You just have some people that say, you know what, I think it might happen, but I don't think it's going to happen, but I want to have just some leverage just in case.
Patricia, thanks so much for the phone call. Let's go to Ray in Balsam Lake. Ray, you're on Your Money with Matt McCann.
Hi, Matt. The question I have is, how long on average does one expect to be in assisted living? In other words, we can determine using, 6% inflation for assisted living, how much it's going to cost per year. But how much money do we need to actually set aside to cover that?
Matt McCann?
Well, first off, cost of long-term care has been going up more in the neighborhood of 2 to 3% going back the last 15, 20 years. So luckily it's not going up, 6%. But as far as how long someone is in assisted living or long-term care, that can vary dramatically. If you're receiving supervisory attention due to a cognitive problem, it depends whether there's other health issues that are involved. And that's the problem with averages, because obviously if you have dementia or Alzheimer's but are otherwise healthy, you could live a very long time in a care situation. It doesn't happen often, but it does happen. Generally speaking, a person needs 2 to 3.5 years of care. Women live longer and need more long-term care than men do. But I hate to use these averages because it varies so dramatically depending on what your situation is.
It is very situational. Let's squeeze in one more phone call. We're running out of time here. Let's go to Mary in Pewaukee. Mary, you're on Your Money.
Oh, hello. I just wanted to point out some things that people need to know based on my experience from having bought a long-term care policy at age 49. I'm now 76. I worked at Duke University Medical Center in North Carolina and retired from there, and so I had an opportunity to buy a policy at a good price at age 49. And I knew it would be a good price because there was a large pool of employees. I'm now on the third insurance company as they've passed off from one to the other as they were sold and found out that it's not a money-making venture. The issue that arises is that the cost does go up as cost rises for daily nursing home care. So I currently pay $900 every 6 months, so about $150 a month. The daily benefit in the nursing home is $155 a day, which is not enough. I've rejected the options to increase the daily benefit because I need to have money to pay for my current health care. And I live alone. I do all my activities of daily living. I drive. I'm active. However, I have Crohn's disease, and the treatment for that today is an outpatient with the new biological drugs. I have one that came out 4 years ago. Every 2 months, I get an IV infusion, and the cost is $19,000. And it's currently being paid 100% by Medicare and my secondary insurance. What if things change on Capitol Hill in D.C. for Medicare or in any other way? I have to have money before I get to that level of care for long-term care, and I wanted people to understand that.
Mary, thank you so much for the phone call and for sharing your experiences with us. Matt McCann, we're down to our last minute. I know this response deserves more than that, but unfortunately that's all the time we have.
Well, she had what's called a guaranteed purchase option, where if the benefits were to go up, she has to pay for it. That is not the type of policy that you want. That is typically found, especially in those old plans. You want a policy where your benefits keep on going up every year, and not your premium, and that's why you need to talk to someone like a long-term care specialist who understands those differences. What Mary did a long time ago was a great idea. It was just the wrong plan and the wrong policy design, unfortunately.
And Matt McCann, we've still got about 30 seconds. Do you have any final words of wisdom about long-term care insurance and what people should be looking for?
Yeah, I think that we didn't really get into the partnership plan. If people Google partnership or go to my website and there's a section on partnership, that is a program that most states, including Wisconsin, offer, which gives consumers additional dollar-for-dollar asset protection. You want to do this sooner than later, and it doesn't hurt to learn about it. You may be predisposed that you think you don't need it, but it's much better to find out what your options are and then decide if it makes sense for you and your family. Some kind of plan, whether it be insurance or some plan with your family, should be done well before retirement so you don't have crisis management with your family.
Matt McCann, thank you so much for joining us. He's a leading long-term health care specialist, the president of McCann Insurance Services of the Chicago area. And On Your Money can be heard live Tuesday mornings at 8 and rebroadcast Saturdays at noon. This hour was produced by Bill Martins with technical direction by executive producer Michelle Johnson. I'm Glenn Moberg in for Kate Archer-Kent. I'll be back in for her again tomorrow. Until then, thanks for listening. And this is the Ideas Network of Wisconsin Public Radio.